If you've been watching California's housing market over the past few years, you know it's been nothing short of a roller coaster. Sky-high prices, bidding wars, homes selling in days, sometimes even hours. But as we move through 2026, something remarkable is happening. The market is shifting, and for the first time in years, we're seeing actual price declines in some of California's major cities. Not a crash, mind you, but a meaningful correction that could create opportunities for buyers who've been sitting on the sidelines. Today, we're diving deep into the 10 California cities experiencing the biggest price cuts in 2026, backed by real data from industry-leading sources like Realtor.com, Zillow, and the California Association of Realtors. Whether you're a potential buyer, a seller trying to time the market, or just someone fascinated by real estate trends, this information could be invaluable. Let's start by understanding the bigger picture. After years of pandemic-fueled price surges that pushed California home values to astronomical levels, the market has entered what experts are calling a reset year. This isn't happening in isolation. Nationally, we're seeing a cooling trend, but California, particularly certain metro areas, is experiencing some of the most significant adjustments. According to recent data from Realtor.com, while home prices nationally are expected to rise modestly by about 2.2% in 2026, 22 of the 100 largest U.S. metros are actually projected to see price declines. And California is prominently featured on that list. The reasons are multifaceted: stretched affordability after years of rapid appreciation, mortgage rates that remain stubbornly above 6%, increased inventory as more homeowners decide to sell, and economic uncertainty that's making buyers more cautious. Here's what's particularly interesting. The West Coast, and California specifically, is seeing some of the steepest corrections. These are markets that experienced explosive growth during the pandemic years as people sought more space. Remote work became normalized, and low interest rates made borrowing cheap. Now, the pendulum is swinging back. So let's count down the 10 California cities with the biggest projected price cuts for 2026. Starting with number 10 and working our way to the top. Number 10 on our list is San Francisco, specifically the San Francisco-Oakland-Hayward metro area. Now, this might surprise some people because San Francisco has long been one of the most expensive housing markets in the entire country. According to Realtor.com's 2026 forecast, this metro is expected to see a price decline of 2.5% year over year. Now, 2.5% might not sound like much, but when you're talking about a market where the median home value hovers around $1.3 million, that translates to real money. Zillow's more recent data shows the trend may actually be steeper, with projections of a 1.6% decline through late 2026. This cooling is being driven by several factors. The tech industry, which has been the backbone of San Francisco's economy and housing demand, has gone through significant layoffs and restructuring. The work-from-home trend has allowed many tech workers to relocate to more affordable areas. And frankly, the combination of high prices, high taxes, and quality of life concerns has pushed some residents to seek opportunities elsewhere. For buyers looking at San Francisco, this represents a notable shift. The frenzied market of just a couple years ago, where homes received multiple offers over asking price, has cooled considerably. Homes are now sitting on the market for an average of 37 days. Up from previous years. The sales price to list price ratio has also dropped, meaning there's more room for negotiation. If you've been priced out of San Francisco in the past, 2026 might offer a window, albeit still at a premium price point compared to most of the country. Moving to number 9, we have Sacramento, the state capital. The Sacramento-Roseville-Arden Arcade Metro is projected to see a 3.3% price decline in 2026. Sacramento has been an interesting market to watch because it became a major beneficiary of the pandemic exodus from the Bay Area. People were seeking more affordable housing while still maintaining proximity to San Francisco, and Sacramento fit the bill perfectly. But now, we're seeing a correction. The median home price in Sacramento, which sits around $573,000, has been experiencing downward pressure. The market saw a 2% dip in the previous year, and forecasters expect this trend to continue. What's driving this? Partly, it's the normalization after rapid gains. Sacramento home prices surged as Bay Area transplants flooded the market, but that wave has subsided. Additionally, inventory has increased significantly, up about 30% compared to year-earlier levels, which gives buyers more options and less urgency. For Sacramento, the market is transitioning from a strong seller's market to something more balanced. Homes are taking longer to sell, averaging around 36 days on the market. The days of multiple offers and bidding wars are largely over, at least for now. If you're considering Sacramento, particularly if you work remotely or are looking for a more affordable California lifestyle, this could be your moment. The city still offers excellent quality of life, good schools, and much lower prices than the coastal metros. Number 8 is actually a bit of a surprise to some people, and that's San Jose. According to December 2025 data from Realtor.com and reported by Fox 11 Los Angeles, San Jose experienced a significant 5.5% price plunge. Now, San Jose is the heart of Silicon Valley, home to some of the world's most valuable tech companies, and historically one of the most expensive housing markets anywhere. But the reality is that even Silicon Valley isn't immune to market forces. High inventory has forced sellers to compete, and not all are willing to drop their prices sufficiently, leading to longer market times and eventual price reductions. The median home value in San Jose remains extraordinarily high, over $1.5 million in many estimates, but the trajectory is downward for the first time in years. What's particularly notable about San Jose is that despite the price decline, it's still ranked as one of the hotter markets for 2026 in terms of buyer activity, coming in at number 5 nationally in some rankings. This seems contradictory until you realize that even with declining prices, San Jose represents value relative to its recent peak, and the economic fundamentals, driven by tech employment, remain relatively strong. If you've been saving for a Silicon Valley home, watching this trend closely could pay off. At number 7, we have San Diego. The San Diego-Carlsbad Metro has been experiencing notable price softness. According to data from late 2025, San Diego saw a 6.7% price plunge, making it one of the sharpest corrections in California. The median home value in San Diego dropped to around $918,000, down 2.6% year-over-year. This is fascinating because San Diego has long been considered one of the most desirable places to live in California, if not the entire United States. The weather is phenomenal, the beaches are world-class, the economy is diverse with strong biotech and military sectors, and the lifestyle is enviable. So why the price decline? Several factors are at play. First, San Diego prices had gotten extremely stretched. At peak, the median was pushing toward $1 million, which priced out a huge segment of the population. Second, mortgage rates above 6% have significantly impacted affordability. A 6.5% rate versus a 3% rate on an $800,000 loan can mean a difference of over $1,000 per month in payments. Third, inventory has been gradually increasing as sellers come to terms with the new reality and list their homes. However, here's the important nuance. San Diego's market isn't collapsing, it's recalibrating. Forecasts for later in 2026 actually suggest we might see modest price growth return, perhaps in the 1 to 2% range, as the market finds its equilibrium. Days on market have increased to around 28 days, up from 20 in the previous year, giving buyers more time to make thoughtful decisions. The market is shifting from strong seller advantage to a more balanced dynamic, which is healthy for long-term sustainability. Coming in at number 6 is Los Angeles. The Los Angeles Long Beach Anaheim Metro, one of the largest housing markets in the country, has seen average home values drop to $942,000, down 1.2% year-over-year as of late 2025. Now, 1.2% might seem modest compared to some other cities on this list, but remember, we're talking about the second largest metropolitan area in the United States. What's interesting about Los Angeles is the incredible diversity of its submarkets. Some neighborhoods in prime coastal areas like Santa Monica, Manhattan Beach, or parts of West LA are holding values relatively well due to limited inventory and high desirability. Meanwhile, areas in the San Fernando Valley, parts of the San Gabriel Valley, and more affordable inland regions are seeing steeper declines as buyers have more options and less urgency. The LA market is also being influenced by some unique factors. Insurance costs have skyrocketed due to wildfire risk, which has made ownership more expensive beyond just the mortgage. Property taxes on $1 million home are substantial. HOA fees, particularly for condos, have increased. All of this creates what one California real estate agent called a perfect storm that pushes some buyers toward renting rather than purchasing. For those eyeing LA, the key is to be micro-market specific. Some neighborhoods offer genuine opportunities in 2026, while others may still be overpriced. Working with a knowledgeable local agent who understands neighborhood-level trends is crucial. And if you can weather the high carrying costs, Los Angeles real estate has historically been a strong long-term investment. At number 5, we have Riverside, part of the Inland Empire. The Riverside-San Bernardino, Ontario metro has seen average home values fall to $578,000, representing a 2.5% decrease. Now, you might be wondering why Riverside is notable when the decline percentage is relatively modest. The answer is about the broader trend and what it represents. The Inland Empire became a major destination during the pandemic for people seeking affordability. You could buy a substantial home in Riverside or San Bernardino for a fraction of what you'd pay in Los Angeles or Orange County. And with remote work, the commute wasn't as much of an issue. Prices surged as a result. But now, as some workers return to offices, the commute factor is back in play. The Inland Empire can mean 1.5 to 2 hour drives each way to coastal employment centers during rush hour. Additionally, the rapid price appreciation made even the Inland Empire less affordable than it used to be. A home that cost $300,000 a few years ago might have peaked at $600,000 or more, and now it's correcting. The positive for buyers is that the Inland Empire still offers some of the best relative value in Southern California. If you work locally or remotely, you can get significantly more house for your money compared to the coast. And with prices moderating, it's becoming more accessible again. Just be aware of the heat during summer months and the commute realities if that's a factor for you. Number 4 brings us to Vallejo. Now, Vallejo might not be as well known as some of the other cities on this list, but it's been an important market to watch. Vallejo is located in the North Bay, positioned between San Francisco and Sacramento, and has served as a more affordable option for people working in either metro. Recent Zillow forecasts have shown Vallejo among California markets predicted to experience declines. While specific 2026 data varies by source, the trend is clear. After years of appreciation driven by Bay Area spillover demand, Vallejo is seeing a pullback. The median home price, while still substantially lower than San Francisco or even Oakland, has been declining as buyers find more options and less competition. What's driving Vallejo's correction? It's partly about overshooting during the hot market years. Buyers stretched to purchase in Vallejo, often paying more than the area's economic fundamentals might justify long-term. Now, with the frenzy subsided, prices are finding a more sustainable level. Additionally, some of the challenges of the area, including higher crime rates in certain neighborhoods and longer commutes, are factoring more heavily into buyer decisions than they did during the pandemic when just getting into homeownership was the priority. For buyers considering Vallejo, there are definitely opportunities, but due diligence is essential. Neighborhood selection matters enormously in terms of both quality of life and investment potential. At number 3, we arrive at what might be the most significant story on this list, Stockton. The Stockton-Lodi metro area is projected to see a 4.1% price decline in 2026, making it the largest decrease in California and the third largest nationwide according to Realtor.com's forecast. This is a substantial correction. The average Stockton home value has dropped to approximately $429,000, down 5.5% over the past year according to Zillow. Some forecasts show even more modest growth expectations, with essentially 0% appreciation projected from early 2025 to early 2026. Stockton represents an interesting case study in market dynamics. The city, located in California's Central Valley, experienced a massive surge during the pandemic. Bay Area residents, priced out of coastal markets, discovered they could buy a nice home in Stockton for a fraction of the cost, while still being within commuting distance, albeit a long one, to jobs in the Bay Area. Prices that had been in the low to mid 300,000s rocketed upward. But several factors are now causing this correction. First, the commute reality has set back in. Stockton to San Francisco or Silicon Valley is a brutal daily drive. Second, While Stockton has improved in many ways over the years, it still faces challenges with crime rates, school quality, and economic development that affect long-term desirability. Third, inventory has increased as sellers realize the peak pricing may be behind them. Here's what's important for buyers considering Stockton. At current prices, it offers some of the best value in Northern California for someone who works locally or remotely. The median price of around $430,000 is far more accessible than anything you'll find in the Bay Area. The city is investing in downtown revitalization and trying to improve its image. But you need to go in with eyes wide open about the community's challenges and limitations. Homes in Stockton are now taking an average of 48 days to sell, compared to much shorter time frames in the hot market. Some properties are selling for about 1% below list price, giving buyers actual negotiating room. If you can identify the better neighborhoods, purchase at current prices, and have a long-term perspective, there's potential. Just make sure this aligns with your lifestyle needs and isn't purely a financial play. As we approach our top two, I want to emphasize something important. These price declines, while notable, are not occurring in a vacuum. Across California, several forces are at work simultaneously. Mortgage rates, while having moderated slightly from their peak above 7%, are still hovering in the 6 to 6.2% range for a 30-year fixed rate. This is dramatically higher than the 2 to 3% rates that were common just a few years ago, and it significantly impacts affordability and buyer purchasing power. At the same time, inventory is increasing. California had been suffering from a severe housing shortage, with inventory at historic lows in 2021 and 2022. Now, we're seeing active listings rise, though they're still below pre-pandemic levels in many markets. This increase in supply, combined with affordability-constrained demand, is putting downward pressure on prices. It's basic economics. When supply increases and demand softens, prices adjust. Additionally, economic uncertainty plays a role. Inflation, while moderating, remains a concern. Employment in some sectors, particularly tech, has softened with layoffs and hiring freezes. The political and policy environment creates uncertainty that makes some buyers hesitant to make the largest financial commitment of their lives. But here's the key point. This is not 2008. We're not seeing a housing crash. The fundamentals are different. Lending standards are much stricter now. Homeowners have significant equity. Most mortgages are fixed rate, not adjustable, so people aren't facing payment shocks. And California's chronic housing shortage, driven by decades of underbuilding and restrictive zoning, isn't going away. This is a correction, a recalibration, a market finding its footing after extraordinary disruption. Now, let's get to number 2 on our list, and this one is significant both in terms of the city's size and the magnitude of decline: Oakland. While Oakland is part of the broader San Francisco-Oakland-Hayward metro that we discussed earlier, drilling down to Oakland specifically reveals even more pronounced trends. Oakland has been experiencing one of the more complex housing situations in California. The city benefited enormously from San Francisco spillover during the tech boom years. Young professionals and families priced out of San Francisco discovered they could get more space, often with better weather and neighborhood character, in Oakland for notably less money. Neighborhoods like Rockridge, Piedmont Avenue, Temescal, and parts of West Oakland became hot commodities. But Oakland has also faced serious challenges. Rising crime rates, particularly property crime and certain violent crimes, have been a major concern for residents. Public safety has become a top issue. Additionally, the same affordability that attracted people from San Francisco eventually made Oakland itself expensive, with median prices pushing toward or exceeding $1 million in desirable neighborhoods. Now we're seeing a meaningful correction. Parts of Oakland are experiencing price declines that exceed the metro area average. Some neighborhoods are seeing values drop by 5% or more year over year. Homes are sitting on the market longer. Sellers who were expecting peak prices are having to adjust their expectations. For buyers, Oakland in 2026 presents a complex decision. On one hand, it's a city with tremendous cultural richness, diversity, better weather than San Francisco, and still relatively good access to employment centers. On the other hand, the challenges are real and not easily dismissed. The key is being extremely selective about neighborhood. The difference between adjacent Oakland neighborhoods in terms of safety, schools, and investment potential can be stark. If you're considering Oakland, spend serious time in the specific neighborhood you're looking at, talk to residents, walk around at different times of day, and really assess whether it fits your comfort level and lifestyle needs. The deals are there for savvy buyers who do their homework. And finally, we arrive at number 1 on our list of California cities with the biggest price cuts in 2026. And the winner, or perhaps we should say the biggest decliner, is actually a tie between several Central Valley communities, but most prominently featured is Fresno. While Fresno doesn't always make the headlines like coastal California cities, it's an important market representing the Central Valley experience. Recent data suggests areas like Fresno, along with other Central Valley cities, have seen some of the most significant corrections in the state as the market recalibrates from the pandemic surge. The Central Valley became a major destination for Bay Area and Southern California residents seeking affordability during the remote work boom. Cities like Fresno, Modesto, Merced, and others saw explosive demand and rapid price appreciation. Homes that had been valued at $200,000 suddenly were selling for $350,000 or $400,000. But the Central Valley comes with trade-offs. Summer temperatures regularly exceed 100 degrees Fahrenheit. Air quality, particularly during wildfire season, can be poor. Job opportunities and wages are generally lower than coastal California. And for those who thought remote work was permanent, the reality of potential return-to-office mandates has made the distance from major employment centers a significant factor. What we're seeing now is a correction that brings prices more in line with local economic realities. While specific 2026 data varies by exact location within the Central Valley, the trend is clear. After outsized gains, these markets are experiencing outsized corrections. This doesn't mean they're bad investments. It means they're returning to more fundamental value relationships. For buyers considering the Central Valley, there's a lot to like if it fits your situation. The cost of living is far lower than coastal California. You can get a lot of house for your money. If you work remotely or in local industries, it can be a great place to build equity and enjoy homeownership. But go in understanding the climate challenges, the distance from major metros if that matters to you, and the economic realities of the region. So where does all this leave us as we think about California's housing market in 2026? Let me share some perspective based on the data we've reviewed. First, for buyers, this is shaping up to be the best environment in several years. The absolute frenzy of the pandemic market, where you had to offer over asking with no contingencies and compete with multiple other buyers, has largely subsided. You have more inventory to choose from, more time to make decisions, and actual negotiating power. In many of these markets we've discussed, homes are sitting long enough that you can do proper due diligence, get inspections, and make informed decisions. However, affordability remains challenging. Even with prices coming down, California housing is still expensive relative to most of the country and relative to local incomes. Mortgage rates in the low 6% range are far higher than what we saw in 2020 and 2021, which means your monthly payments are significantly higher even if the purchase price is somewhat lower. You need to budget carefully and be realistic about what you can afford on a monthly basis. For sellers, the market requires a different mindset than a few years ago. You can't just list at an aspirational price and expect multiple offers. You need to price competitively from day one based on current comparable sales, not what your neighbor sold for in 2022. You need to present your home well, with quality photos, proper staging if appropriate, and you need to be prepared to negotiate. Sellers who understand the current market and price accordingly are still selling, often successfully. Those who are holding out for peak prices are watching their homes sit. For investors, the current environment is actually quite interesting. If you have a long-term perspective, buying during a correction phase can be smart. California's fundamental housing shortage hasn't been solved. Population, while it's seen some outmigration, is still enormous. And the state's economy, despite challenges, remains one of the largest in the world. Quality properties in good locations, purchased at correction prices, have historically performed well over time. Looking ahead to the second half of 2026 and into 2027, most forecasts suggest we'll see stabilization and then potentially modest appreciation returning. The National Association of Realtors predicts existing home sales will rise 6% in 2025 and 11% in 2026 nationally, with California likely to participate in that recovery. mortgage rates may drift down into the high fives or low sixes, which would help affordability. And as inventory and demand find better balance, prices should stabilize. One critical point to emphasize: real estate is inherently local. Even within the cities we've discussed, there's enormous variation. A luxury home in coastal San Diego may see completely different dynamics than a starter home in East County. A premium neighborhood in San Francisco may hold value, while less desirable areas decline more steeply. This is why working with knowledgeable local real estate professionals who understand micro-market trends is so valuable. Also, consider your personal situation and time frame. Real estate is not a get-rich-quick scheme, despite what some influencers might suggest. If you're buying a home to live in for 5, 10, or more years, short-term price fluctuations matter less than finding a property that fits your life and that you can afford comfortably. If you're investing, you need to understand rental markets, cash flow, property management, and be prepared for the reality that real estate is often an illiquid investment. Let me also address something important: the fear of buying before the bottom. Many people are wondering if they should wait for prices to fall further before purchasing. Here's the reality: timing the exact bottom of any market is essentially impossible. By the time you're confident the bottom has been reached, prices have usually already started recovering. Real estate doesn't have a bell that rings at the lowest point. What's more important is buying within your means, in a location that works for your life, at a price that makes sense based on comparable sales and your own analysis. If you find a property that checks those boxes, don't try to be a hero and wait for an extra 5 or 10% decline that may or may not materialize. As the saying goes, you make money in real estate when you buy, not when you sell, so buying well matters more than buying at the absolute perfect moment. For those worried about buying now and then seeing further price declines, remember that if you're in the property for the long term and you can afford the payments, short-term paper losses are just that, paper losses. California real estate has a long history of appreciating over extended time frames, driven by population, limited buildable land, and strong economic fundamentals. I also want to address the rent versus buy question because it's particularly relevant in this market environment. With prices still high and mortgage rates elevated, renting can actually make mathematical sense in some California markets, at least in the short term. You avoid the large down payment, the maintenance costs, the property tax hit, and you maintain flexibility. However, renting means you're building equity for your landlord, not for yourself. You're subject to rent increases. You don't benefit from potential property appreciation, and you miss out on the tax advantages of homeownership, including mortgage interest deductions and the eventual capital gains exclusion when you sell. There's no universal right answer. It depends on your financial situation, your career stability, your family plans, and your risk tolerance. But if you're in a position to buy, can afford it comfortably, and plan to stay put for several years, homeownership remains one of the most reliable wealth-building tools for middle-class Americans, even in expensive California. As we wrap up, let me share a few key takeaways. California's housing market in 2026 is experiencing a meaningful shift. After years of rapid appreciation that priced many people out and created an unsustainable market, we're seeing corrections in major cities ranging from modest to significant. Stockton leads California with a projected 4.1% decline, followed by Sacramento, San Francisco, and several others. This is creating a more balanced market where buyers have actual negotiating power for the first time in years. Inventory is increasing, days on market are longer, and sellers are more willing to negotiate. For those who've been waiting on the sidelines, 2026 offers a window of opportunity. At the same time, this isn't a crash. Fundamentals are sound, lending is tight, homeowners have equity, and California's housing shortage persists. This is a correction, a recalibration, and likely temporary before modest appreciation returns. Whether you're buying, selling, or investing, success comes from understanding local market dynamics, working with quality professionals, making decisions based on data rather than emotion, and having realistic expectations. California real estate will continue to be expensive by national standards. It will continue to be volatile. But for those who approach it thoughtfully, it remains one of the world's most dynamic and ultimately rewarding real estate markets. Thank you for watching. If you found this information valuable, please like this video, subscribe to the channel, and share it with anyone who might benefit from understanding California's housing market in 2026. And remember, while I've provided data and analysis, every real estate decision is personal. Do your homework, consult professionals, and make choices that align with your individual circumstances and goals. Best of luck in your real estate journey.